Hello, in this video I want to show you inventory accounting in perpetual format. In this format we have the results of inventory real time, which means when we purchase a product, the inventory effect is registered immediately into the ledger. It means that when we take in trial balance of our account, we will see the amount of inventory is somehow matching with the real items which we have in inventory. Now I'm going through example and I will show you, walk you through a simple inventory transaction which can happen during the financial period. For this, I will purchase an item and then sell it, and after I sell it, I came to know that this item has more cost for us because the delivery cost has not been considered during the purchasing of item, and after that we want to have our corrective registration into our inventory. Let's see how we can handle this scenario. First, the first incident of this can be when we purchase items. In this scenario, inventory will be CR. Suppose we have purchased item 1, 10 items at the price of 6, which will be 60 in total. Let the currency be USD, dollar. From now on I will say dollar. Okay. In this case, inventory will be debited $10 and the vendor will be credited $10. If you would like to reflect it into T accounting, we can say this $10. No, sorry, this is not $10. It's $60 because 10 into 6 is 60. Okay, it's $60. Inventory will be debited and the vendor will be credited by $60. Okay. After that, we are gonna sell this item at a price of, for example, 6. Then we have this transaction recorded into our JV, general voucher, and general ledger for that is like this. Sales will be credited and cost of goods sold, no. Customer will be debited because we sell this item at the rate of 7. We will sell all of items $70, and then the sales account will be credited $70. At this point, we have no item in our inventory. The customer is debited $70 and the sales would be credited $70. Okay, let's clear this by color so that you can understand this better. Let's have this color for this and this color for that. Oh, that's good. Okay. As you can see, our inventory remains 60. As I said, in perpetual inventory accounting, we should reflect the change immediately when the financial transactions happen. And in this case, when we sell item, something happened in our inventory which we sold item. If it is a period accounting, at the end of period, we have a simple formula which have opening and then purchase during period. It would be added together and closing balance, closing quantity. It would be cost of goods sold. But we have to wait all the period to find our cost of goods sold. In perpetual inventory accounting, we can immediately record this after we raise sales invoice or when we raise delivery note. It's based on company requirements. Some companies want to have its effect when the sales invoice is raised. Some companies don't want to have a separated delivery note for this. Let me show you which is the recording registration of general ledger for this transaction. In this transaction, all our inventory, because of all of inventory sold, the inventory should be credited. It is a convention in accounting that we have to register first the account which is debited. So, which account is debited? It is, of course, this which I show you in the periodic accounting, cost of goods sold. In abbreviation, it is sometimes write as this, COGS. COGS account. COGS account would be debited $60, and the sales account and the inventory account would be credited $60. Okay. Now, the $60 will be reflected here in the cost of goods sold. $60 will be reflected here. Let me have these two separated by color. Yeah, this color is okay. And now we have completed a cycle of purchasing item and selling item. After we have done this, then something might happen. Sometimes we find that the freight or custom or something else is not included into formula. So we have to also register that into our accounting. For that, I'm not sure in which format we can do this. But something like this should happen, because in perpetual accounting we don't have a separated account as purchase. We should debit inventory, because it will also increase the value of our inventory. For this, let us have $12, so that it's have a factor of 6 in it, so that in future I can have a good number. And in this case, the account which should be credited is freight. And I cannot immediately credit expense account, so I have to have freight account. Freight account has to be $12 debited, and then freight account of the type of income and expense. It is not it is a temporary account. It is not the account which comes into trial balance. And then the after, because we paid, normally a bank or cash has to be credited or debited for this $12. And then this inventory will be debited, and the freight expense has to be credited. One of the practice we can use for these type of things, for the account which are fixed, such as freight, we normally know how much is the freight for this many items, so we can get a provision account at the time of purchasing the item. So the inventory will be added as $12, and the cost of goods sold also has to be affected, which should add it as $12 in somewhere in our accounting. These things I'm not sure about how we can do this, but the point is that we have to have the stock valuation correct. For example, if we want to know in this state what is the stock value for these items, average, depending on the formula which we calculate the average rate, or LIFO or FIFO, we have to know exactly which is the cost of this product at any specific date. So we have to have somehow manage this, and all ERP system has some tricks to do these kind of things into this. If you're going to buy an ERP system, always consider this item as a important case that you have to discuss with your ERP vendor. Thanks for listening to this video.